Hello everybody and welcome to part 4 of our lecture on chapter 5. Where we left off on the last lecture, we had talked about the specific identification method. Now we're going to move on to the next method, which is first in, first out, or FIFO. Now we're going to carry on with the exact same example, but this scenario is just a little bit different. Okay, we still have the 2 cans of Coke. The first one was $1 and the second one was $1.20. And we're still selling 1 can of Coke for $1.50. But now, because it says I don't know for sure which can I sold, so I will assume FIFO. So in this case, because specific identification is not available for this type of product, there's no way to know which can we sold, if it was this can that cost us $1 or this can that cost us $1.20. So we have to make an assumption about which one we sold. And in this case, the assumption we're going to make is that the first thing that came in was the first thing that came out. And that's why I have the cans associated in the chart like this, because it's putting the inventory into what we call cost layers. And that means each time we buy inventory, we add another layer of cost to this situation. And so here you see our first cost layer is the can of Coke that we first bought, which was $1. And then our second cost layer is the next can of Coke we bought, which was $1.20. And we need to keep them in layers so that we can keep track of what's coming in and what's coming out, because now our assumption is all based on timing. And when we bought it is how we're going to assume that we sell it as well. So in this particular instance, we're recording our sales entry, and the revenue part looks exactly the same. We're still selling that can of Coke for $1.50, so we've got it for $1.50 here. But now for our cost of goods sold and inventory, the accounts, again, are still the same in the journal entry. What's different, though, is the amount. And it's different this time because we're making an assumption about which one we sold. We don't know for certain which it was, but we're going to assume that the first cost layer that came in is also the first cost layer that's going to go out. So this first cost layer, we're going to assume is what was sold. So what was sold is your cost of goods sold. So we're going to take this dollar here from this first cost layer and put it here in our entry. And that means that what's left is the second cost layer, or the newer items that we bought, more recently or later in the process. And that is our ending inventory, is the one that was $1.20, right? Because if these 2 cans were available for sale, one of 2 things happened. Either we sold it and it's cost of goods sold, or we still have it and it's in ending inventory. Now we need to figure out, well, which one is which? Well, we're going to assume the dollar is the one that was sold and the $1.20 is the one that remains under this FIFO assumption. And now you see when we calculate gross profit, our gross profit is different, right? Our sales was still the same, still the $1.50 here, but now because our cost of goods sold changed to $1, cost of goods sold is $1 here. Now in this case, our gross profit is 50 cents. So now let's look at comparison of the 2 methods we've done so far. You see now that our cost of goods sold is the $1 can. So what remains in ending inventory is the other can that we didn't sell, $1.20. But still, the sum of the cost of goods sold and the ending inventory is still $2.20, as it must be, because that $2.20 is your goods available for sale. And under all of these scenarios, the amount available for sale is going to be the same. The difference is how we figure out, well, which was the ones we sold and which is the ones that remain in inventory. And then you see here that our gross profit is different. Now it's 50 cents instead of the 30 cents it was under specific identification. Okay, so you see here that a lot of the numbers have changed under this different assumption. Okay, now let's move on to the next assumption. And that's similar to the one we just did, but a little bit different. This time we're going to assume last in, first out. So the last or most recent stuff we bought is the first stuff that we're going to sell. So here we have that same scenario. We're going to sell 1 can of Coke for $1.50, but we don't know for sure which one it is, so we're going to assume LIFO, or last in, first out. And what you see here is we still have the same cost layers. We still have our first cost layer is the first thing we bought, which was $1. And the second cost layer is the second thing we bought, which was $1.20. But now when we go to figure out what we sold, we're going to pull from the last that came in. So this second cost layer is where we're going to pull for our cost of goods sold. And there you see in our cost of goods sold now, we have the $1.20 and our inventory going down $1.20. So that means what remains in inventory is this first can that we bought, which was $1. Okay. Now, when you calculate your gross profit, sales, again, is still the same, still $1.50. That hasn't changed. But what's different is now the cost of goods sold under LIFO is $1.20 because we're going to use the last thing that we bought as our cost of goods sold. We're going to assume that's the can that was sold. And then our gross profit becomes 30 cents. So now, again, we're going to compare the methods. And under LIFO, our cost of goods sold is the last can we bought, which was $1.20. Our ending inventory is the first can we bought. It's still sitting there on our shelf because we haven't sold it. And but the total still, again, is $2.20, as it is on every single one of these methods. And it must be because this is what we had available for sale, which is $2.20. But the split between what is sold and what remains in ending inventory is different. Okay, and now again, our gross profit is 30 cents, so that's now different than what we had for FIFO. So the difference between these two assumptions, and by the way, these two are assumptions because specific identification is not an assumption. We know for sure if we can specifically identify it, but FIFO and LIFO are assumptions because we don't know for sure, so we have to assume one or the other. Okay. So now we have one more method that we need to learn, and that's weighted average. And weighted average, I'm going to tell you, is the most complicated of all four methods. So you want to pay close attention here. Now what weighted average says, and usually for most people, weighted average is kind of the thing that makes the most sense. Like, oh, I'm just going to take an average of the two costs, right? If I buy something at two different costs, I should average the two, and it makes sense. But I want to be clear about what kind of average this is. This is a weighted average, okay? It's not a simple average, it's a weighted average. So the formula that you're going to use is very important, okay? Your formula for weighted average, you're going to take the total cost of what you purchased and divide that by the total number of units. So in this case, our total cost, it was the $1 can plus the $1.20 can, which equals $2.20. Our total number of units was 2 cans, so we divide that by 2. And if you do the math there, you get an average of $1.10, okay? Now in this particular case, because there's only 2 cans, the weighted average and the simple average are the same. But I'm going to show you later on how it can be different. So that's why this formula is really, really important. I want you to make sure that you know this formula and that you use it properly. But the result of this calculation is this. In our accounting records now, we no longer have cost layers. We don't have 1 can that's $1 and 1 can that's $1.20. No, this is gone. That's why I have a big X through it. Instead, what we have are 2 cans that each have the same weighted average cost of $1.10 each. Okay, so no cost layers in weighted average. It's just whatever you have in inventory now all has the same cost. That same weighted average cost you use for all of your cans. So now, if we look at our journal entries, our goods available for sale now look like 2 cans at $1.10 each. Okay, so it really doesn't matter which can you use. We're just taking a weighted average. So we're just going to say, okay, so one of those cans was our cost of goods sold and one of those cans was inventory. Uh-oh, my little arrow here is pointing to the wrong thing. Let me fix that. There we go. So what we have here is that our 110 cost of goods sold goes here. And oh, sorry, another typo on my slide. Sorry about that, guys. But it should be weighted average for both, right? We use our weighted average of 110 and 110 here in our journal entry for the expense side of our sales. The revenue side, of course, is the same. It hasn't changed. And now when we look at our gross profit, our sales is still $1.50. We still sold that can of Coke for $1.50. But our cost of goods sold now is 110, the weighted average cost. So now our gross profit is $1.40. So let's go ahead and compare those methods right now. We see that under weighted average, our cost of goods sold is 110. And our ending inventory is 110, right? They're the same. And again, the total of both of them is 220, which again is the same under every single method because that is your cost of goods available for sale, right? Your cost of goods sold and your ending inventory must equal your cost of goods available for sale. But now under this scenario, we have weighted average gross profit now of 40 cents. So that's different than any of the other methods. Okay. So now you can see how depending on which method you use, you're going to have a different result. Your financial statements are going to look different because your cost of goods sold is going to be different, your ending inventory is going to be different, and your gross profit is going to be different. Now, before we move on, I want to give you a couple tips related to weighted average because, again, I told you this was the most complicated of them all. And my two tips are this. The two things I want you to remember are, number one, to use the weighted average formula, not a simple average. And number two, you must calculate a new weighted average prior to each sale. And I'll give you some examples of those right now. So now let's give you another scenario. Okay, in this different scenario, we say one can was purchased for $1, but now instead of purchasing one can for $1.20, we purchased 3 cans for $1.20. And if you figure out the total purchase cost of those, we had $1 here, right? 1 can for $1. And then here we have 3 cans for $1.20. That equals $3.60. So the total goods available for sale was $4.60. Now, using a simple average, you might want to take this $1 and this $1.20 and calculate the average between those two. So we would do that. $1 plus $1.20 equals $2.20. Divided by 2 equals 110. But the problem with that is now if you figure out the value of all of those cans, because remember now we have 4 cans that all have the same weighted average cost. If you go back and put that cost value of $1.10 on each of these 4 cans, you have 4 cans times $1.10 equals $4.40. But that's not our total goods available for sale, right? Our total goods available for sale was $4.60, not $4.40. The problem with using this simple average is that you're treating each of these cans the same, but they're not the same. There's 1 can that was $1.10 and 3 that had a higher cost of $1.20. So you have to put a higher weight on the more expensive ones. So let me show you what that looks like. So in this case, we've got the 1 can that was $1.10 and the 3 cans that were $3.60. And you see here now we're going to put a higher weight on these 3 cans that were heavier or more costly. So the way the math works is now we take a weighted average. Okay, we're going to take, remember, total cost, which was $4.60. And so we have $4.60 as our numerator. And then we divide that by the total number of units, which we have 4 units, right? So 4 cans. And now our weighted average is $1.15. And that's higher than the simple average of 110 because we're putting a higher weight on the ones that are more expensive. There were more that were more expensive, so our weighted average is going to be higher than our simple average. Then we check our math. 4 cans times $1.15 equals $4.60. and that matches our cost of goods available for sale.